thank you everybody for joining us today. I believe this will be your first and last presentation about a company focused on properties leased to the Postal Service. So the story kind of starts with me, which really, louder, sorry. Story starts actually with my father. My father had owned all different types of real estate in his life, was presented with a small portfolio of properties leased to the Postal Service. At the time, didn't even realize that the Postal Service leased their assets. This was in the early 80s. He bought that small portfolio. And what he found very early on, and what we've proven out to be true, are kind of three foundational pillars. First and foremost is because of the lease structure, we're able to own and operate these properties throughout the entire country. We currently own about 1,900 properties in 49 states, Puerto Rico, Hawaii, and Alaska. Before you guys ask, the one state we don't have properties in is Rhode Island. Second is that we collect 100% of our rent 100% of the time. Doesn't matter if there's a government shutdown, COVID, any economic cycle, we always collect our rent. Number three, which is the largest misconception in postal real estate, is the fact that the Postal Service very rarely leaves. We've had a 99% retention rate over the past 10 plus years. These three factors drove my father to continue buying these assets. He grew the portfolio. In 2000, he semi-retired. I took over the business, kind of institutionalized it a bit, continued to grow the portfolio. Somewhat more aggressively, became the largest owner of assets leased to the Postal Service as a private company. My father passed away a little over 9 years ago. After his passing, I was approached by an investment banker to create a public company around our portfolio. Never thought about it, had no interest in being a public company CEO. As nice as you guys are, no interest in being here. I worked for myself, had no investors, was very low levered, which were typically drivers of a public company. But I spent about a year or so trying to understand if there was an opportunity here. I learned a lot about myself, met some really smart people. But what I learned is that even though that I was the largest owner, I was a very small piece of the pie. Postal Real Estate 101, there are about 32,000 facilities throughout the country. Postal Service leases 23,000 of them. They pay $1.4 billion in rent for those 23,000 facilities. Depending on what margin you put on it or what cap rate you put on it, that's a $12 to $15 billion market. Those 23,000 facilities are owned by about 17,000 owners. That's how fragmented the market is. That $1.4 billion they pay in rent only accounts for about 1.5% of the Postal Service's total operating expenses. So the backbone of their entire delivery business only costs them about 1.5% of their operating expenses. So I happened to be sitting at the right seat at the right time and at the right age and decided to go public. I seeded the public company with the lion's share of my personal assets. This was not a monetization for me. I took back everything in equity in the public company. I happen to be one of the largest shareholders of the public company. We started at 271 properties, and we've grown the company by 6 or 7 times. We're about 1,900 properties now. I should also note that I don't take any cash compensation. I take all my compensation in equity. We got slowed down a bit with COVID. We got slowed down a bit with the current interest rate environment. This year, we articulated originally to be $80 million of acquisitions for the year. We've grown that guidance to $110 million at or above a 7.5 cap, and we're well on our way to achieve that. We currently own 8% of the postal market. The next 20 largest owners altogether only own about 11%. That's how fragmented and how inefficient and large this market is. I would argue that we have all or most of the institutional knowledge in the space. The 200 to 300 buildings that we buy a year, 75% of them are off market. And I mean properly off market, they do not touch a broker. This speaks to who we are in the space. This speaks to our reputation, certainty of execution. I guess that's the background. I mean, I'll pass it over to Steve, our CFO, to give a little more on our finances and balance sheet.
Absolutely. I'll cover balance sheet. We're highly focused on maintaining a low levered balance sheet. We don't need to lever up in order to generate the consistent positive returns that we've generated. As of the third quarter, we had 5.2 times debt to EBITDA and around 40% loan to value. We're also very focused on increasing our access to both debt and equity capital. In the third quarter, we recast our credit facilities. We expanded our total borrowing capacity by $40 million. which we were able to secure at a 4.7% interest rate. Of that capacity, we also have $125 million that's unutilized today, and that's before giving effect to $250 million of accordion capacity we could utilize if the right opportunities come our way. So we're very well positioned on the debt side to fund our future growth. On the equity side, we've evolved massively in our time as a public company. Initially, we were very thinly traded as a $100 million equity cap company. Today, we're a $500 million equity cap company. We trade much more than we did in the past, so we're able to utilize what's called an at-the-market equity facility, where we can raise equity very efficiently on a daily basis, and we do that accretively to increase our earnings in future years. The last thing I'll say is that we also have increased our retained cash flow significantly since coming public. We have around $10 million per year today, which we can pair with debt to fuel our growth through acquisitions.
So pre-IPO, this was all a thesis. No one had ever done this before. There's no other public company focused on postal real estate. And my thesis was driven by a few things. First and foremost, most postal owners, typically 60s to 80s in terms of their age, own their building 40 to 50 years, little or no depreciable basis. And most of the motivation for selling is typically a life event or estate planning. I believed that structuring this as an UPREIT, which provides with an operating partnership unit currency, was going to be a big driver of deal flow. We spoke with a lot of investors before we went public, and a lot of them said, you know, a lot of people say they're going to use it, and very rarely do they actually use that currency to drive deals. We've done 10 to 15% of our deal flow with that currency, and a lot more of it is driven to us just because we have the currency, even if we don't close with it. The second part of my thesis was that I felt like creating an institutional owner was going to change the dynamic with the Postal Service. And in the beginning, we negotiate with the Postal Service, and most owners deal with Jones Lang LaSalle to negotiate their leases. Because of our size and scale, I approached them about negotiating directly with them, which they agreed to. And that was a savings to us. We have a proprietary lease amendment. But the real change came in 2022, when we were all living through a hyperinflationary environment. I approached the Postal Service about changing their lease terms. So a typical postal lease is 5 years in term and has no escalations. We were able to achieve 3.5% annual escalations on the leases that rolled in 2022. And that set the precedent for an escalation. Now, bear in mind that these are only for our leases. There's no other portfolio owner that has this. In 23, we effectuated that precedent by getting a 3% annual escalation. And we've been able to continue to maintain that 3% annual escalation through our 26 lease rolls. Currently, and through 26, we have 53% of our leases have annual escalations. 37% of our leases then have 10-year leases. So we changed the dynamic after we got the escalation and opened up the conversation to extending the lease term from 5 to 10 years, what the Postal Service has now agreed to. What you'll see is that the compounding effect of these escalators, as well as our mark-to-markets, have given us the ability to put up and project for same-store NOI growth for this year to be between 8.5% and 9.5%. It'll also show you that our earnings are proposed to be this year between 12 and 14%. A lot of this has to do with the mark-to-market of leases. A lot of this has to do with the compounding effect of those annual escalations. And they also have to do with the efficiencies that we find operating this portfolio at this scale. These numbers, we're very proud of them. We've worked very hard to achieve them, and they're outsized for anybody in the REIT space. I'm hoping this gives us a background to open up the floor to any questions that anybody may have.
Are they triple net leases?
They're not. I refer to them as modified double net lease. I made up the term. It's the owner's responsible for roof, structure, and insurance. That's our primary responsibilities. The single largest expense we have is in roofing. Sure.
On the acquisition strategy, you mentioned that we tend to be like life events. But how do you, what is it, 3% a year you said? But, geographically, what's your strategy geographically? You said something about 3 to 5%?
So the 3% is the escalator in the lease. Geographically, we don't have a motivation. We go where the deal takes us. It doesn't really matter to us. The two large underwriting criteria that we have are, first and foremost, that the building is important to the Postal Service. And second is that we're buying these at good real estate values on a price per square foot basis.
Okay, yeah, I think that slide is actually what I'm asking for, how you guys across the country.
What you'll find is the Postal Service, when they started building this network, they started on the East Coast and they started going west. And different than a strategy that I think would have been implemented today, they didn't go to large developer to build the portfolio. They went to each individual town, put out an RFP, and allowed local owners the ability to build and own their post office. As they got to the Mississippi and west, they ended up building and owning for their own portfolio. So you'll see that east of the Mississippi, they lease more properties, and as a result, we own more properties east of the Mississippi.
Is there any threat to closing post offices going forward from digital process versus physical? I just don't know if the market's going to keep growing.
So I don't think the market is growing, and I don't think the market needs to grow. The footprint of these buildings is there, and it's been in place for a long time. And it hasn't expanded or contracted in any significant way, which explains my 99% retention rate. But I think your question is slightly different, right? The reality is the Postal Service is not about mail.
Right.
Packages are the future, though. And so if you think about what the Postal Service is, and you think about what we're investing in, right? The Postal Service has a virtual monopoly on the last mile. That's just reality. The Postal Service touches 169 million delivery points, 6 to 7 days a week, right? That's the target market of every online retailer, right? And every delivery service provider and every online retailer leverages and uses the Postal Service network in order to get to the American people. And that's what we're investing in. We're investing in critical logistics infrastructure. Each one of these buildings is a node on a logistics chain, and you can't touch those people without having that network in place. So I would argue strongly in the fact that as time goes on, the future of retail is e-commerce. And that's the case. People want to get to the American people as quickly as possible, and they can't do that without the Postal Service.
I was just wondering, when you look at it as a risk profile, other than cap rate and interest rates moving up and putting valuation in real estate,
Yep.
what other risk profiles do you have?
I'm arguably very, very biased, but I don't believe that this is a risky asset. The way my father looked at it and the way that I look at it, and I believe the way the company is run, is this is a government or real estate backed bond. This is a very defensive play. We pay a 6+% dividend. We have significant growth. We have arguably the best credit tenant in the world. We have arguably one of the highest retention rates that you're going to find in REIT land, and definitely the best rent collection. So you're diversified across close to 2,000 properties in 49 states. So you check that box. You're diversified by asset class. I don't see the risk.
So Blackstone didn't consider going into this business?
So interestingly enough, I think that the barrier to entry for a Blackstone is because of the per ticket price, right? The average post office is about $500,000.
That's too small.
Correct. Correct. Please.
So you kind of answered some in the last question, because part of it is, what are your rent collections like in challenging times? One would assume, like here, the most recent government shutdown, follow a number of other government services providers, they were not getting paid.
Mm-hmm.
Now, eventually they get paid, but they weren't getting paid when the government was shut down. How does that work with you guys? And if you look at, when the economy has, been challenged in the past, how has that impacted your guys' results?
So it's a common question, and you need to understand that we are not the GSA. And so the General Services Administration is the branch of the government that governs all of those leases for those government buildings. When the government shut down, those buildings don't get paid, those landlords don't get paid. The Postal Service is outside of that. We get paid. Government shutdowns don't affect us, economic cycles do not affect us. We have maintained that 99% retention rate and 100% rent collected in every economic cycle, COVID, government shutdowns, multiple of them. It doesn't change anything for us. I don't know the makeup of the people in this room, but for the real estate investors at heart, there's another differentiating factor for us, and I believe that there are a lot of them, but this is one that most real estate investors will understand. There's usually a gap between gross effective rent and net effective rent, okay? And that translates into when a landlord gives a tenant free rent or tenant improvement dollars or CapEx, or they have to pay leasing commissions, and as a result, the rent that they state is not the rent that they actually receive. I refer to it as leakage. We don't have any of that. Okay, this is a continued occupancy. We do not pay leasing commissions. We do not pay for CapEx. We do not give free rent. The lease ends today. The next lease starts tomorrow. We collect rent the entire time.
Any target pricing from any analysts out there following you?
I don't know, off the top of my head, I don't know the average target price. I'm not sure, Jordan, if you have that.
It's around 18, 19.
Who's your biggest shareholder? Other than you, institutional?
Fidelity,
Yeah, okay. How long have they been in?
for a long time.
By what price?
So it's Fidelity. So they buy and sell, and
accumulate,
yeah,
so-
they continue to accumulate and right-size their position as we continue to grow.
So you talked about the dividend over 6%. Maybe you could give us a little bit more about your philosophy there, in the dividend policy that you have.
Yeah, sure, I can take that. Coming out as a public company, we wanted to pay a high dividend to attract dividend-oriented investors. Over time, Andrew and team increasingly understood the power of retaining cash flow. So in 2023, the company made an intentional decision to grow the dividend less quickly than our AFFO per share growth, AFFO being the REIT's equivalent of earnings per share. So over that time, we've significantly expanded the retained cash flow that we have in the business. So today we're paying out 97 cents a share of dividends, and we're going to earn around $1.31 of AFFO per share, which is a proxy for our free cash flow. You do the math, and it gives us around $10 million of cash flow to lever up and invest in a given year. As we move forward, there are REIT requirements around how much of our net income we have to pay out. At some point in the future, we won't be able to continue growing the dividend more slowly than our AFFO. We'll have to mirror our AFFO growth in order to maintain our compliance with REIT rules.
I'd like to add to that we have grown our dividend every year since IPO. So even though it's some years that it's slower than others, our dividend has grown every year since going public.
So I assume a lot of these buildings have been in the trust for decades, perhaps?
Well, the business has only been public for 6 years, 6+ years.
So, yeah, where I was kind of headed was, are they fully depreciated, a lot of these, or, are you do it over 30 years, or what terms?
Well, as a REIT, we don't pay income taxes, so we're not tax sensitive. We do have a
On your
depreciable,
balance sheet, you're still writing off.
and we're still taking depreciation. I believe we replenished that when we came public.
The book value of the properties is not indicative of the actual value of the property, because for someone like myself or other people that have used the operating partnership unit to contribute their properties, the basis in the property carries forward into the public company. So it's not indicative value of what the real estate itself is worth.
So looking across the entire portfolio,
Yep.
how many of it, or what percent of it would you say, if the post office did not renew, there was a higher and better use for that property?
So it's a really good question. I don't know the answer. The way that I look at it is there are properties in a portfolio that have a higher and better use. Legally, you're not allowed to evict a government tenant. Okay, so the name of this game is to create that bond, to aggregate the story, to create the cash flows. The higher and better use that would be achieved from these properties, and there are properties in this portfolio that have that significant higher and better use. It's really the gravy at the end of the train, not the train. But I don't have a percentage for you.
Fair enough.
Does the post office put out new bids for new construction, and did you look at that?
They do, not very often. It's usually, thank you. They do it typically because there's some, natural disaster or some need for them to rebuild a building. I don't typically compete for those. I found that people that buy those buildings are usually overpaying on a price per square foot basis because people are capitalizing not just the underlying rent, but also the TIs and the cost of construction. And at the end of the lease term, I'm somewhat concerned that the rent is going to mark down. And so those are not deals that I aggressively go after.
With more than 6,000 small and micro cap companies listed, if you're looking for the next Apple, then Channel Check truly is your tree. It's an investor community where you can access independent Wall Street research, advanced market data, balanced news, corporate videos, and podcasts. You can even register to attend in-person Meet the Management Series luncheons, and to be part of the preeminent annual Small and Microcap Investor Conference, NobleCon. And here's the best news. Since Channel Check is sponsored by the featured companies, premium membership requires no investment. It's absolutely free. So check it out. Log in today. Find out why Channel Check is North America's leading source of research on the companies that just may change the world.